Hello and welcome to our First Trade education series, sponsored by First Trade and presented by Options Play. Today's presentation is titled Understanding Exercise and Assignment. It's going to address a few of the basic things in options and talk about some of the landmines that can be created by exercise and assignment and not actually understanding them. So I would put this in as we're going to lean to the basic side of things as far as option trading is concerned, but it's also very important because there's a lot of advanced traders that don't always think about exercise and assignment. And in this marketplace, it's very important to understand in a market where there's zero commissions now on stock trades, it changes the dynamics of the options trading world. So before we get too far along though, I have to just say that this is part of the Options Play education series. We are dedicated to try to enhance option trading across the globe, if you will, and learn a little bit more about what drives these volumes in the options marketplace day to day. Each and every year, it seems like we set new records in option trading, and we're just trying to bring it out to the masses. All right. So we have a disclaimer. If we do show actual securities today, they're not meant to be a recommendation. And that's very important that we're just putting together a PowerPoint slide doesn't necessarily mean that if we talk about a specific stock that is a recommendation from this event. Also, on the First Trade side of things, we're looking at the characteristics and risks of standardized options. If you do not have a copy, you can ask for one. You can also find one that's all available all over the web, but you should read that before you trade options. All right, we're going to look at the four basic positions. So to start with, we're going to go through the very basics of options, but these are very important concepts that are always worth reviewing. If you buy a call option, in this scenario, you have a scenario where you are the buyer of a call option and you and once you buy that call option, you are then considered long that option in the account. Now, as far as this presentation is concerned, we're thinking about the what am I trying to say here? We're thinking more on the end of if you buy a call option, you have a right. But if you sell a call option, you take on an obligation. And that's the very important concept here, because that obligation means that exercise and assignment is important, right? You receive cash, and for that cash, you take on that obligation. So if I'm the buyer of a call, I have a right. Exercise and assignment is all in my control. I determine when I want to exercise, if I want to exercise, and what happens after I exercise. On the seller side of things, I receive the cash from the buyer, and because of that, I'm then considered short. And once I'm short an option contract, I no longer have any rights. I have an obligation, and my obligation on the call side of things is going to be to sell stock. Now, this is actually where the term call comes from, though. It comes from the sell side of things. If you are buying a call option, you have the right to call stock away from somebody. Now, on the other side of the coin, on the put side, if you are the buyer of the put, once again, you have all the rights. You pay the cash. You have the right to sell the underlying stock at a specified price called the strike price. And that means that I'm going to be bearish on the underlying stock. But if I'm the seller, I receive that cash, and because of that, I get cash now. I'm going to take on an obligation, and that obligation is going to be to buy that underlying. Then I am then considered short. So once again, the term put comes from the sell side of things. If I buy an option contract, I have the right to put stock to the seller. So call means you're calling stock away. Put means you're putting stock to someone. But bottom line, today is all about this obligation to sell and this obligation to buy. And we're going to talk when that happens and just some things to think about when we get into exercise and assignment. So, option pricing. Now, there is a mystery because option pricing is definitely different than the pricing of a stock. There are many different expiration dates. There are many different strike prices to choose from. There's a time factor because an option is an actual contract, and there's an expiration date. So all of these things get figured into the price of the option. It matters if the underlying stock is in the money, if there's real value, intrinsic value that's in that option contract, and if it's out of the money and there's no intrinsic value. More time. Time is going to be money. Other things in the marketplace can also affect an option's price. And we're going to look at this from the sell side of things and talk about the insurance aspect that follows along with option pricing. Like, for example, when you pay for your car insurance, and we're going to do a little example using car insurance, you say you're paying your premium for your car insurance policy, right? Well, in the options trading world too, we use that same vernacular when we're talking about an options price. We call it the premium of that option contract. So if we're just thinking about an options price overall, if there is intrinsic value in the option contract, if there is real value, well, the option's got to trade for that, right? It's got to trade for that real value, which means that we are in the money on our option contract, and there is also a lot of times premium above and beyond that amount. And we call that extrinsic value, not intrinsic, but extrinsic, or better known as time value, right? That's really what a lot of people refer it to it as. So intrinsic means that I'm in the money. Extrinsic is time value, and it's made up of the length until the expiration date, the number of days, and also if there's any known events. So implied how volatile the stock has been just in general. The marketplace has been very volatile overall, not to mention the fact that we now are in earnings season. So a lot of stocks, not only do we have the actual volatility of the marketplace, but there is a special announcement that we call earnings. And that all gets figured into this premium or this price as far as the option contract is concerned. The intrinsic value, it's always got to trade for that. So it's always going to be trading for that intrinsic value. And then you got external factors that affect the options price, like time value and implied volatility. So let's work through one example here. Our stock is going to be a fictitious stock, ABC. And ABC is trading at 103. We look at the ABC 30-day, DTE stands for days to expiration, 100 strike call option. And we see that that is trading for $5. So in this instance, we have intrinsic value. Why? Because we see the stock is trading at 103, and we have a call option to buy the stock at 100. So if we exercised our right, we could buy the stock at 100, sell it on the marketplace at 103. That means that we have intrinsic value. But there's also $2 that's remaining in that, and that price is considered time value of the option contract. So we have the right to buy at 100. ABC is at 103. 103 minus 100 means that $3 of this $5 premium is intrinsic value or in the money amount. What we're really concerned with, and especially today when we're talking about exercise and assignment, is the extrinsic value. The total premium for that option contract is $5. The in the money amount is 3. You take 5 minus 3 and you come up with the time value of $2 on this option contract. That goes out 30 days until the expiration date on this fictitious stock called ABC. All right, so now when I think about option pricing, well, let me jump back one slide, okay? Why is this $2? Right? We said it's 30 days, but why $2? Why isn't it $1.50? Why isn't it $2.25? Right? Why? What makes up that $2, and how do we come up with that $2? So to understand this, first of all, we got to get to the fact that an option is a contract, And I'm going to work a lot with this aspect of it, implied volatility. And we're going to think about the option pricing components. Now, when I'm thinking about a basic option seminar, I guess, I think a lot of people come with the attitude that we're going to use options to speculate on stock price movement. We're going to use the leverage of that option contract, and that's why I want to trade options. And if you take that attitude, it's kind of hard to understand option pricing because, as I've mentioned more than once, option pricing has more to do with, or is similar to, the insurance world more than even the stock world when it comes to pricing an option contract. And also, in just to use the similarities thing, if you sell an option contract, once you've sold it, you're considered short. We already highlighted that, but you're also referred to as the writer of the contract. And if you think about any insurance policy, what do they reference insurance companies as? Underwriters, right? So if I go out and I ask for a quote on my car insurance, they say, well, let me send it to the underwriters because they're writing up a contract based off of certain things inside your profile to determine what the price of your car insurance could be. Well, in the options trading world, options were actually invented or used as a way to insure an asset. That's the main way that it came from before the Chicago Board Option Exchange started trading options. And 1973, when they opened up their exchange and started trading listed option contracts. Up until that date, option contracts did exist all the time, and they were written up just much like an insurance policy on a plethora of different underlying assets. Okay, so I digress. Let's look at what the pricing components of an option contract are. So in our instance, we have ABC. It's a 30-day 100 strike call or put option. We're going to focus on the put option because I think it's a little bit easier to understand that as insurance. And whenever you see a quote on an option contract, by the way, all it is a truncated contract, right? You have your contract over here, and in the terms and conditions of the contract, it mentions the underlying stock, which is ABC. It usually represents 100 shares. It mentions the expiration date. This expiration date is 30 days away, right? And that's in the body of the contract. Also, 100 strike call option. So it tells you the buy or sell price, depending on if it's a put or a call. And it also is going to highlight if it's a put or a call, the type of the option contract. So all of that entire contract is written up and actually quoted, and that quote actually tells you what you have to pay for that option contract. It's usually based on 100 shares, so you multiply it by that 100 shares. Now, what's real interesting is I actually wrote a chapter in Options Essentials, which was one of the first chapters I ever wrote as far as option trading is concerned. And it covered, where option trading came from. And back in the day, they used to actually just publish contracts and say, hey, we have this option contract. Would anybody like to buy or sell this option contract? And that actually was a start to the quote page. So they'd actually show a picture of the contract inside the newspaper or whatever publication that they were looking at. And we have actual contracts were written up and exchanged in order to buy and sell options prior to the Chicago Board Option Exchange actually trading listed option contracts. All right, so if we go back, we say the insurance contract, right? Think of an option contract, and we're going to talk about a stock at, we're going to use this 100 strike. So the stock's at 105, right? We'll say the stock's at 105. We're going to look at the 100 strike put option here. So in this instance, if we're thinking about that, we own 100 shares of stock. We buy a put that allows us to put stock to somebody at $100. If you think of that relative, and we use that, that would be called a protective put. And think of an insurance contract on your car. So what's the price of the asset? Well, that's going to affect the price of the insurance product and of the stock. The more expensive the underlying, the more expensive the insurance contract is going to be. So in this instance, if you're looking at insurance on a BMW versus a Chevy Cobalt, right? There's a little bit of difference in price in that actual car. And because of that, you're going to have a difference in premium if you insure that product. Stock world, that matters, right? If I have a stock that's trading at 100, 105 in our instance here, then you got more risk than a stock that's trading at $10. 105 could go all the way down to zero. If it's trading at $10, it could go all the way only down to zero. That can only move 10 points. So that's going to get reflected in the option price and the option contract. Deductible. Very rarely do you buy your car insurance and not have a deductible. Why? Because it's very expensive to have the zero deductible car insurance. And that's also true in the options trading world. So you have to decide your deductible, but that is decided in the options trading world by looking at the strike price. In our instance, the stock's at 105. We've got the 100 strike call here. So we're saying that we'll take the first 5 points of risk. So on 100 shares, that's $500 deductible. But from 100 on down, I want the right to put the stock to somebody. Time is time, as Mother always said, time is money. The more expensive that, or the more time that you have till expiration, the more expensive the policy is going to be. Now, one thing that is interesting in the options world is that and we'll talk a little bit about this, but options decay at the square root of time. I know that's a fun concept you want to tell your friends and family about, but what it just means is that time decay accelerates as the expiration date approaches. I guess there's a little bit of that in your insurance policy, but it's not quite the same as in the options trading world. But there's many different dates to choose from in the options world. Insurance, you usually look at a 6-month or a 1-year policy. And then you have carry costs, interest rates and dividends. And the dividends play a big deal in the exercise and assignment of things, especially in call options. We'll get into that a little bit. But carry costs, when you pay for your car insurance, when do you pay for it? At the beginning of the term or at the end? Well, you do it at the beginning, right? You pay for it up front and then you own that insurance contract. You don't wait till the end of the term and say, okay, I didn't crash my car, so here you go, here's my money for my policy, and you pay for it in arrears. You pay for it up front, and because of that, the insurance companies can earn interest on the monies that you paid over the life of that contract. And the concept would be that if they did really well with the interest rate or whatever you want to call it, or investing it, and then on your next 6-month policy, they should give you a discount because they made money on your money. That would be nice, and in theory, that's the way it would work, but it doesn't happen, obviously, in the insurance world. But carry costs matter. Interest rates are a big deal. Interest rates also matter in the pricing of an option contract, but the dividend is a big thing. Stocks pay dividends, cars don't. Cars, you can't drive a car around for 3 months and they come back and say, oh, thank you for driving a car around, here's some money, right? The dealership doesn't do that, but in the stock world, they do. Sometimes they'll pay dividends, and because of that, that gets figured into the price of the option. And then we got the level of risk. Actuarial science comes out and says this person has a riskier profile than that person. Maybe it's a father that's a teacher that likes to drive a Chevy Caravan around, or is the person Navy SEAL that might just drive the hot rod off the cliff for a training exercise, right? There's a difference in level of risk when it comes to the insurance contract. In the options trading world, we call that volatility, and actually we call that implied volatility, what the marketplace is implying the volatility to be over the life of the option contract. And that matters a lot, especially around the earnings season. But if you put this into an insurance model, you come up with a premium. You put this into an option pricing model, you come up with a premium. And that's where we come up with that all-important thing that we call time value and intrinsic value. And all of these components make up that price of the option contract. But the most important thing to get your hands around if you're a beginning option trader is to understand that the price of the option contract has this component that needs to be figured out that is above and beyond any intrinsic value as far as your option contract is concerned. Now, if you have any questions, because I think this is a fairly decent stopping point, please do put them in the Q&A box. The chat box is not available to all. It's just the Q&A box, which you'll see a little question mark. If you click on that, that'll pop up, and you can put any questions into that Q&A box that you might have, and I'll try to address them throughout this presentation. All right, so we saw the price of the option. We know that the option is a contract. Now, if I bought the option contract, what can I do? And if I sold the option contract, what can I do? What are my choices? And what happens more often than not? So if you do own an option contract, first of all, to enter the trade on an option, because it is very easy to sell an option without owning it. There are stipulations behind, you got to regulatory requirements, you got to fill out the proper paperwork and all that, but you can sell an option contract fairly easy, especially if you own 100 shares of stock and you're selling an option on that underlying. So when I do this, when I'm selling it, the options marketplace will make you enter that order as I'm buying to open, or I'm buying to close, or I'm selling to open and I'm selling to close. And if you look at that as far as options are concerned, once I own an option contract or I am short an option contract, well, then I can go out and I can either close the position if I would like to. That means I'm going to buy and close that position either to make a profit or to cut a loss short, right? I have that ability to trade because there are exchanges that allow you to trade options, and they're fairly liquid, way better than they used to be back in the day when they advertised in the newspaper, right? And then they could expire worthless. If they expire worthless, they are out of the money on that scenario. Now, that's bad if you own the option contract, but that's good if you don't, if you sold the option contract. So bad news for longs, but it's good news for shorts. So keep that in mind. And then in the end, if you are in the money, you can either exercise your option contract, and if it's a call option, you'll be buying, or if it's a put option, you'll be selling. And there is a DNE, means do not exercise, and I'm going to address that actually a little bit later. This is just a reminder to talk about DNE, do not exercise, because if you do not put that in, you're either going to be buying or selling the underlying stock. All right, so I have two questions that popped up before I get to the next slide here. Joe says, how do the Greeks factor in? The Greeks are just a tool to help you understand the variables. So if I go back, before I move too far along, there's a Greek that goes along with the stock price movement. That's delta. There's a Greek that goes along with the expiration date. That's theta. So a Greek is spewed out from an option pricing model when you're trying to figure out the premium. There's one that tracks volatility. That's called Vega. So all that the Greeks do is give you an indication in theory of how your option should move as these variables move, Joe. That's where that comes from. When do you research and plan your trades? Justin is asking. When do you research and plan your trades? Well, I don't know if that's really goes along with this, Justin, but if you're researching and planning a trade, you want to do that ahead of time. You want to know that you want to trade on this underlying and look at your option contract based off of that. So I don't know if there's another question in there. Is that like a personal question? When do I research it? But go ahead. We'll leave it at that. If you want to follow up on it, I'll try to answer that question, Justin. All right. Now, so these are the three choices. You got choice 1, choice 2, or choice 3. Which one do you think happens the most? And we've covered this a little bit before, so I'm kind of thinking that a lot of people will get this one right, and I'm kind of hoping that that will be the case. So in the Q&A box, just type in 1, 2, or 3. You have these three things that could happen. What do you think happens more often? People close their positions once they're established. They let them expire worthless, which is number 2. Or do you think it's number 3? They actually expire in the money and somebody exercises, which means someone else gets assigned. So far, we're getting the 2s are winning, and not a lot of people playing in my reindeer game right now. Do you guys want to jump in? It's a good chance to try out that Q&A box. So we get a lot of number 2s, few number 1s. All right, let me remove a few of these. I think the 2s have it right now. And that is probably one of the biggest misunderstandings in the options trading world, is that most option contracts expire worthless. And you kind of think of it this way too. If you got a call option contract on this side, you got a put option contract on the other side. So if they do go open interest, we're going to talk about here, that's not 100% right, but puts would be in the money, calls would be out of the money, so that kind of affects things. Bottom line is it's not number 2. And that's probably the most common answer we get. The most common thing that happens is actually people close the position. And here's the way the numbers work out. So if we click on this, we go back to here. 10% of options are actually exercised. Only 20% expire worthless. And 70% of options are actually traded out of. In other words, they are bought to open or sold to open and then bought to close. So 70% of the time, an option contract doesn't even make it to the expiration date because it was closed out prior to getting there. And it kind of makes sense, because just think of, if you've ever traded an option before, let's say you bought a call option and the market's not going the way you want. Do you usually just ride and say, oh gosh, I guess I lost all my premium because I was wrong? No, you go out and you say, all right, it didn't do this on the chart, and because of that, I'm going to close my position. Or the company announced earnings and it didn't turn out too well as far as the earnings, so I'm going to close. Or it turned out really well, and I'm going to take that opportunity and I'm going to close that position. Why? Because there is an listed marketplace that I can close these positions on. Only 20% of options expire worthless, and that kind of makes sense when you think about it, because, well, first of all, it's a good thing if you're short. It's a bad thing if you're long. So some people want those option contracts to expire worthless. And only 10% of option contracts really get exercised or assigned. Now, this is a general numbers as far as the markets are concerned, but they don't really move a lot. I think exercise has kind of bumped up a little bit because of the thing that I mentioned on the top of the show, that more often than not, you will, nowadays, the fact that there is no commission to buy the stock if you exercise or get assigned changes the dynamic of the marketplace a little bit. So I think that percentage has gone up a little bit higher as far as the number of option contracts that are exercised or assigned. So this gets into the concept of the assignment process. So about 10% of option contracts get assigned, but it's very important to note that if you sell an option contract, you are not in control. And the way that you get the assignment notice is somebody in general, and we'll talk about this, is not necessarily the person that you initially sold it to, but it's everything. It's like triply random, if you will, in that the long option holder would exercise their option contract. That goes to the broker. The broker then sends that notice that somebody is exercising to the Options Clearing Corporation. And the OCC, which it is commonly referred to as, is a very important cog in the wheel, because they make sure that the person on the other side of the contract is going to make good on their obligation. And if they don't make good on their obligation, the Options Clearing Corporation is going to make good on that obligation. All right. So that was a very important step or process or cog that we had to put into the wheel to make the listed marketplace work. Once that happens, then the OCC assigns it to a broker, and then that broker assigns it to a particular client. So somebody in that brokerage firm is short an option contract, and it might be this person, and the next time it could be that person, it could be that person, it could be this one. So it's all random from the beginning to the end as far as the assignment process is concerned. All right, now, with all that said, if an option contract is in the money, the Options Clearing Corporation is going to exercise on that client's behalf, even if it's 1 cent in the money. That's the concept. So if you have an option contract that just finishes a few cents in the money, realize that you're probably going to be assigned on your short option contract if that happens. Now, every once in a while, you might get lucky and somebody does not exercise or enters a do not exercise. So there is that possibility. But 99% of the time, if you are in the money, you are going to be assigned on your short option contract. All right. So how does this play in? Well, open interest is a term that you don't find in the stock marketplace. And it's a very important term. And exercise and assignment really matters based off of open interest. Because if we go back to here, right, and I'm going to define open interest a little bit more, but if there's only this blue person here and none of these other people exist because nobody else has the option contract open, guess what? You're going to get the assignment, right? So if there's no one else that is interested in the option contract that you're trading and somebody exercises on this side of the equation over here, you're going to get the assignment notice on this side because you're the only one that's there. So open interest does matter. It matters with liquidity, how wide bid-ask spreads are, the ability to get in and out of an option position, and it also matters a lot as far as the assignment process is concerned. So I'm going to take the time to define it. So we'll talk about the picture. Don't get distracted by that, but that is a valid question. Why is there a picture of a hot potato? And I will address that. But now let's get into what open interest is. Okay. Simply put, open interest is the number of option contracts that exist for a particular stock. High open interest means more interest. All right. So if an exchange says we are going to open, and in our example, we had the 100 strike call on ABC. Let's say we're going to open up a new strike. We have a new expiration date. We are going to open up some new contracts. All right. So we're going to open up a 8-month option contract with the 110 strike. And I'm just picking these numbers randomly. Once that quote comes out, that contract isn't alive, right? Because nobody's traded it yet. So there's no open interest. There's nobody that's at, until somebody actually buys one of those options and somebody sells, then the contract exists. It can be quoted all day long, but now it's just a piece of paper. Until it actually gets bought and sold, then it becomes an actual contract. And if you look at that, the volume will tell you that there are some contracts that are traded, but you don't necessarily know if they're opening or closing. And that's why the Options Clearing Corporation makes brokers mark their tickets that you are buying to open or you are buying to close. Are you selling to open or selling to close? So if you see an option contract that has a lot of open interest and all of a sudden you see a lot of volume that's going on, guess what? The next day the open interest could actually go down. Why? Because there were more closing trades than opening trades. I want open interest if I'm going to be trading. I like to trade the contract that has a lot of open interest. It usually means you're going to have a better marketplace in general if more people are interested in the option contract. So I kind of explained how it's tallied, but let me review it. It's updated at the end of the day, so you're not going to see open interest move. You're going to see volume move, but the Options Clearing Corporation will come in the end of the day, look at all the tickets and decide should open interest go up or should it go down. It does not change during the day or during the session. Open interest can reflect all contracts on the stock. So you could say this stock has an open interest of X number of contracts. And a lot of times they'll quote that when a stock is in the news, that the open interest, the total open interest on the stock had, doubled because a lot of people are trading options or speculating on the price. That's what is usually meant when they're saying that. The price movement, I should say. But it can also be measured by option type, expiration, and strike. Okay, so that's how I like to look at it, because I want to look at an option chain, which inside First Trade, you look at the option trade and look at the open interest, and you'd see which option contract in that expiration has the most open interest. A lot of times it's going to be somewhere close to where the underlying stock is, an at-the-money option contract, if you will. But it is tallied every day. It goes up, it goes down, based off of the stock price movement and the number of contracts that are traded. So why is there a picture of a hot potato? Well, I think a lot of people think of an option contract when we get that answer to go back to the slide previous, where more people thought number 2 was the answer, that most option contracts expire worthless. That's because they're thinking of an option as a hot potato. It gets opened and we got to switch it. I'm done using it. So here, you take it. No, you take it. And it's going to expire worthless or in the money in somebody's hand at the end. And that's not the case. Once you close it out, you move on. It's not a hot potato. The contract will cease to exist if the option contract gets closed. And if that happens, open interest will decrease the next day. All right, any questions on that? On open interest. All right. So, I want to talk about a couple of landmines that happen with exercise and assignment. But let me slide back, and I'm getting a little bit long in the tooth here. I'm going to jump back here to this slide and open that slide up. Okay, now, when you think of a call or a put option, and you got to think of this, and we're going to specifically talk about exercise and assignment, and I'm going to give you a homework to do if you're thinking about exercise and assignment that's going to cover some of these concepts that we have, and this video will be made available to you through First Trade. But if you buy a call option and you have 30 days to expiration, let me grab a little bit of water. All right. And you have 30 days to expiration, and the stock is now trading at 103, like we talked about with our time value. Is the person going to exercise right away? You had a 30-day option contract, 15 days go away, and before you know it, this is trade. The stock ABC is at 103. That means on our call option, we're 3 points in the money. Should I exercise at that point in time? Why would I? Right? Two things. First of all, we know from the slide previous that this option contract with 30 days remaining was trading for $5, right? Because it had, with the stock at 103, because it had intrinsic value and it had time value. So if I exercise now as opposed to closing it, I don't get that time value. It all goes away. I just get the intrinsic value. So why don't I go to the options marketplace and exercise it? Next thing, if I do exercise it, what am I doing with cash as far as the call is concerned? What am I doing? I'm spending cash. I paid $5, or I don't know where the price was when we first started, but let's say I paid some money for that option contract, but it was a lot less than buying 100 shares of stock, right? So 15 days go away. I still got 15 more days to do it. Would I want to spend cash now, or would I rather wait 15 more days and spend cash later? Saying I want to own the stock, I want to own it. If I want to own it, do I want to buy it now, or do I want to buy it 15 days from now? I know the price. The price is going to be 100. I want to do it 15 days from now, right? I want to spend cash later. And that is very true on the call side of things. So there's two reasons why I might not uh, exercise an option contract when it gets in the money. And this applies for both puts or calls, is that first of all, there might be some time value left in the option. And I don't want to leave that on the table. I'd rather capture the time premium if I could. And with the call option, it kind of makes sense to not exercise now because I don't want to spend cash now. I know the price that I'm going to get, but why do I want to spend cash now when I can spend cash later? And on top of it, it could go down over the next 15 days below the strike price. Then I really got egg on my face, right? Because, gosh, I could have just let the option expire worthless and buy the stock at a lower price if I wanted to, right, than the strike price. Now, on the put side of things, the first one applies, time premium. Well, it might be in the put if that one gets in the money. But the other side of the coin is not true, right? If you exercise a put, you get cash now. Do I want my cash now or do I want my cash later? Well, some people might say I want it now. I just want out of the stock. I don't want to try to capture all the time premium, if you will. And if that is the case, then I may exercise early just because I'm getting cash now. So with puts, it's a little bit different than calls. But there is one thing that is very true, and this is why I came back to the slide, is that stocks pay dividends. And guess what? If you own an option contract, you don't get that dividend. So the one time that somebody might want to pay cash now is because the stock is paying a very big dividend. It's usually got to be a big dividend. And that dividend is worth more than the time value that's left in the option contract. And I know that I want to own the stock. I got to know that I want to own it. So I exercise before the ex-dividend date. So now this happens in the SPY, for example, with the most popular ETF that's out there. That ETF actually pays dividends. And we've seen call options get exercised prior to that dividend, especially as expiration approaches and there's less and less time value that's in that option contract as that expiration approaches. Okay, now here comes Richard with a really good question, which I was just going to get to, so perfect timing, Richard. Richard says, how long after 4 p.m. can a position be closed? Well, closed is the wrong word. You'd say exercised. And usually after you can exercise anytime during the day. Most of the time with most brokerage firms, not a lot of people do it electronically. You got to call up and say, I want to exercise at any time during the day. But you do also get the benefit that if the market's closed, you can exercise your call or put option if you own that option contract. And the Options Clearing Corporation says it's got to be exercised by 5:30, but most brokerage firms aren't going to have everybody call at 5:30 to exercise. So they put a limit on. They might say 4:30 because you're going to see where the market's at, or they might even let you go as late as 5 o'clock. But bottom line is, if you want to exercise after the market is closed, you can do that, but you have to check with your brokerage firm as far as the rules are concerned. All right, so yeah, you can exercise an option contract. And that is a great segue, and I might as well just escape once again and jump ahead into some of the landmines that you want to think about. All right, so here's where exercise and assignment is important. And like I said, this started out as a very basic webinar, but we're going to end up just talking about some of the landmines that exercise and assignment can cause. So keep this in mind. Take a swig of your tea or your coffee or something to, do a little face slap. But this is why we're talking about this topic. And one of the things is a surprise assignment. And these are scenarios, by the way, that I've actually addressed with members of Options Play because they've came up. They've came up from time to time. So here's an example. And they're usually, once again, around big events that will happen. But a company reported earnings after the close on Wednesday, December 11th. Now, it's very important that it is a Wednesday. And we're looking at the 13th, which is the Friday expiration date. So you got a couple of days remaining, right? So the market is all the way up here at 550. The market after that earnings report dropped precipitously, almost 50 points. But that's only like 10%, but it's still a lot of points, and that, that does matter. And it opened down around here. Let's call it 490, somewhere in that range. When it was all said and done, it closed at 474. Now, this person had a long put spread in. So they were right. They're happy, right? Well, if anything, they're kind of sad because they should have just bought the put outright. But they bought a put that gave them the right to put stock to somebody at 540, but then they sold a put that gave them the obligation to buy stock or have it put to them at 540. Well, it went down. It's at the maximum. You're definitely going to get the full 10 points for this. And I think at that point in time, they probably paid about $2 for that trade. So they paid $2. It's going to be trading for somewhere close to 10. And the day went by, and this person didn't close at the end of the day when the stock was all the way down here at 474. They didn't enter an order to say, I want to close out my long spread. Maybe they fell asleep, maybe they did whatever. But guess what happened to this 540 option contract when the stock closed at $474? It was worth a lot of money. The bid-ask spread, and I'm going to highlight this down here, widened. And it became fairly illiquid because it was so deep in the money. So the person that owned this 540 strike put or entity or whatever decided that they didn't want to deal with the bid-ask spread. So instead of selling to close that position, because there's no time premium in that, they exercised. And this person got assigned on one leg of this person's spread. Nothing wrong with that as long as you're ready for it. But the next day, the person woke up to a quote-unquote margin call in their account saying you have to buy 100 shares of a $540 stock, which is now trading for $474, by the way, and it's continuing down. All right, so what should that person do? What should that person do? You have to come up with $54,000, right, to buy the 100 shares. Or what could you do? And I'm looking at the Q&A box. What can I do with that? What should the person do? There's an obvious answer to this. Now remember, we're on Thursday. You wake up, the market went down. Let's write the scenario. The market went down. You were correct on your forecast. You did well on your trade, but you did not close it out. You wake up on Friday morning and you had stock put to you at your short strike of $5.40, saying you got to buy 100 shares at $5.40. All right, so we got two answers, and they're both the exact opposite. And I agree with Justin, by the way. Justin came out with the best scenario. You exercise a long put, right? You're deep in the money. You have the same scenario that prompted the person to exercise the 540 in that you have an option contract that you paid $2 for, which is now probably trading for close to $100. Well, 75 at least, right? Well, 550, yeah, 75. I'm just taking 550 minus the stock price. And now the bid-ask spread has gotten wide. So if anything, they gave you a bonus by exercising the short put. And you should be happy that it happened. But the correct answer is just say, oh, don't worry about the fact that your broker is telling you that you have a margin call to buy 100 shares of a $540 stock. Just say, exercise my long put, and I will make my $10 on my long put spread. That's simple. That's the correct answer. Now, Scott said, sell your long and buy back your short because you don't have the, well, you got put the stock. You'd be selling your stock and then you'd be selling your long put option. But in that scenario, then you still got to deal with the wide bid-ask spread on the long put. And you still, in that instance, have not sold the stock. So if the stock's still moving, you still got stock price fluctuation that's happening, and you're dealing with trying to execute a now illiquid option contract and get rid of the stock, and you got the broker calling you, telling you that you have a margin requirement, which they really shouldn't be doing. They should be calling up and saying that you should exercise. But this is a scenario, this happened. This is not a joke, and it happens more often than not, especially in a volatile marketplace, especially around earnings. So the correct answer was given by Justin right away. If you think about this, the broker would not let you put this trade in if it wasn't covered, right? If they didn't think you had limited risk. And if you put the stock at 540 and the stock continues to do this, and you're buying a stock at $540, which now ended up all the way down almost to about 440 or 430 before it made a small bounce back up. So in this instance, the broker let you put in the trade because you were covered, because you had the right, you have the obligation to take the stock at 440, but you had the right to put it to somebody at 540. Landmine number one. Deep in the money option contracts will become illiquid if you don't close it out. Well, here's actually the first thing that should have been done. When you made your profit, you probably should have just closed it the day after the earnings, right? You're 75 points in the money, close it out. You might have to pay a dime or a nickel to get rid of it, but just do it and close it out and be done with it. So you made $9.90 as opposed to $10 because that's the width between the strikes, right? Okay. All right, I'll let that go. I'm harping on it. Does that make sense? Now, Richard says, what I mean was how long after 4 p.m. can I buy a short to close the contract? Oh, okay. So you're talking about after hours trading. And once again, that is dependent on the brokerage firm. The brokerage firm does allow, most brokerage firms do allow after hours trading. And I can't speak for each broker. Once again, I just work for Options Play. So, but usually have an hour. There you go. Usually have an hour after the close to buy or sell the stock in the secondary marketplace. But every brokerage firm is different. All right, I'm getting a little bit long here, but here. So now I also have another one. So don't forget that you can exercise after the market. This one's going to be very straightforward, but here's a scenario, and this once again happened to somebody. I think this was in earnings. Okay, so you're short one ABC March 21st, 122 strike put. Okay, 122 strike put. The stock closed at 122.01. All right, well, on a put option for it to be in the money, it would have to be below the strike, right? So it's 1 cent out of the money in this instance. Market was way down. This was an earnings report. Ended up closing right down here, 122.01. It actually drifted a little bit lower during the day, down towards 120. Came back and closed right here. And you say, shoo, I didn't get assigned on my put option. But guess what? As Richard points out, after hours, the stock still trades. And what happened here was the stock continued on down after hours and landed somewhere around the 121 level. That person that thought they escaped the assignment of the put woke up the next day, and this was, okay, ABC closed on Friday, okay, so this was Friday, so they woke up on Monday to an assignment on that put option contract, and they owned the stock at 122 with the stock trading at 121. Somewhere in that range when the market opened on Monday. So once again, this is a landmine that goes with assignment. You have to realize that after hours trading does matter. And until you remove that obligation, so at this point in time, as we went into the market, this person could have closed this out for a nickel, right? Maximum paid 5 cents. They might have been able, if it traded in the pennies pilot, they might have been able to pay 1 or 2 cents. But the bottom line is they could have removed that risk. The stock continued to trade after hours. The person that was on the other side said, hey, I can't close my option anymore, but I can exercise it. So, and the OCC here does exercise, and that does happen. Okay, now the other side of the coin, and this is where the do not exercise happens. What if you own the put and it ended up being 1 cent in the money? Not 1 cent out of the money, but you owned it. Well, the brokerage firm, by rule, would exercise on your behalf and you would sell stock. All right? So once again, when you're around the strike price, you get to expiration. Not talking about just being short and taking on obligations. Sometimes if you're long, you might want to tell your broker, do not exercise, DNE, on my behalf. Do not exercise on my behalf. Or, once again, sell it and close it. Get out of the position so you don't have that risk. Don't fall asleep on the expiration date of your option contracts, especially with the zero DTE craze that's going on, which means you're just basically trading an option contract that lives only for one trading session. All right? How does a seller close a short position? It's exactly the vernacular we talked about, Anonymous. Anonymous, we said, right? You sell to open, and then you buy to close, and you remove that obligation. And when you wake up in the next day, your transaction reduced the open interest by 1 contract as far as the marketplace is concerned. So I am selling to open, buying to close, or I'm buying to open and selling to close. That's the vernacular of the marketplace. And yeah, I could close out this option. I was short the put option per se. I'll say it as me, but it was a member. But you're short that option contract, the 122 strike. The market is coming to an end. I know that I'm going to be really close to where this is at. I pay a nickel. I pay 5 cents or $5 plus commission to close that trade. And that's what usually gets it, is people just don't want to pay that 50-cent commission to close the trade out. But at First Trade, you don't even have to worry about that, right? All right, everyone. Great presentation. We're right at 1 o'clock. So, my name is Brian Overby. Moral to the story, don't fall asleep on option expiration. That's the moral to the story. Understand exercise and assignment. Other side of the coin. Maybe I want to exercise my put because the bid-ask spread is wide. What if I did that scenario where I was long the put option? Know what your options are. You are a smarter trader now since we went through this presentation. I work for Options Play, optionsplay.com. Check out the site. You have all the information available to you at First Trade. I wrote a little book called the optionsplaybook.com, and I was going to give you an assignment, so I will do that. If you go to optionsplaybook.com and you want to learn more about early exercise and in particular about dividends and how they affect calls, if you just go to this little box and you put in exercise, right there, it will give you the search, or you can go through the table and try to figure it out that way. But this site is free for all. It's all the content of my book, which is the Options Playbook, which is available on Amazon. But all the content is available. You just hit click buy the book if you want. But all the content is available on optionsplaybook.com, 100% free. All right. I guess that'll be it. I'm going to leave it there. And let's put this up one last time. If you want to learn more about what I'm doing, please follow me on x.com. My handle is @BrianOverby. Thanks for stopping in, and I always like, and we'll see you the next time for the next educational series sponsored by First Trade and presented by Options Play. Thanks for tuning in.